Market volatility has caused a rotation into defensive stocks, but is it too late for investors to get in on that trend? Joining us now to discuss is Jeff Evans, VP, Director and Lead of Empirical Research and PM Support with TD Asset Management. Jeff, great to have you back on the program.
It's great to be here as always. Thank you very much.
So understandably, we have seen this rotation amid all of this market volatility. I can't believe it's still the month of April. So much has happened since April 2nd. This move that we've seen in the markets, is it a bit too late to get involved?
Exactly. Well, it's been pretty much a big roller coaster over the last month or two, and in particular, pretty much from January 20th, when the inauguration happened, is when we started to see a lot of these dynamics start to shift. And not unsurprisingly, when you get lots of uncertainty and lots of volatility, investors do what humans normally do. You find somewhere safe to hide. We're definitely seeing that in the equity markets, with investors coming out of the more cyclical areas of the market, things like energy and semiconductors coming under a little bit of pressure, rotating into these more defensive stocks like utilities, just given the uncertainty, and also some of the stronger earnings growth potential in utilities as well. Now, that said, what's interesting when you have some of these risk-off rotations, we're seeing it in the equity markets at the sector level. You would normally expect to see the same thing at a country level as well. So you'd expect to see investors rotating out of emerging markets and coming into the U.S., these large liquid markets. Of course, we've seen exactly the opposite. China at one point had outperformed the U.S. by almost 30% a few weeks ago. So very different from what a typical defensive rotation would look like. And then you've also seen a couple of other concerning things. The other standard safe havens like the U.S. dollar and U.S. treasuries, dollar under pressure, treasury yields rising. But then, of course, gold is up at the same time. So it really depends on how you think about defensive stocks. We are seeing a lot of things that are behaving very differently than they normally would. So the way we tend to like thinking about this is instead of putting an arbitrary label and just saying the U.S. should always be a safe haven, we're thinking about it more in terms of volatility. So which stocks and which investments are behaving in a more stable way, acting like that safe haven and not showing a lot of volatility in the price. When we run those numbers and look at a low volatility versus a high volatility basket over the last 3 months, we've seen one of the largest defensive moves in 25 years. So it's a 15 to 20% move, depending precisely on what you put in the basket, in a very short period of time. And so the problem is, to become incrementally defensive at this point, you almost have to start thinking about a scenario more in line with the financial crisis, because that's where you saw an even bigger defensive rotation.
Things have to get worse from here, which we hope they don't.
We hope they don't.
Yeah.
And fortunately, what the data is telling us right now, if you look at things like consensus estimates for U.S. GDP growth, consensus still expects about 2% real GDP. That's down from 2.2 a couple weeks ago, but it's not zero and it's not negative. S&P 500 revenue growth is still around 4%. You typically don't start seeing layoffs until that gets into the 1% to 2% range, so we've got a nice buffer there. And earnings growth, even though earnings have been revised down a little bit in the last couple of weeks, we're still seeing fairly robust earnings growth in the U.S. And none of that suggests to me that sort of danger or recessionary scenario is playing out. So I think chasing defensive stocks at this point to get incremental alpha probably won't work. But with that said, these are still companies that are 20 to 30% less volatile than the broader equity market. When this ultimately starts to change, I think it's going to be a very slow rotation. It won't just suddenly be a switch back to risk on and all the cyclical stocks outperforming. So I think investors probably over the next 6 to 12 months can benefit from lower volatility. And as the markets start to pick back up in time, you'll still have the opportunity to rotate back in. So I think that's the way to think about it is, the full defensive rotation has probably played out unless we see further deterioration. But there's still a good opportunity to take some volatility out in the near term and wait for some clarity.
So many fascinating pieces that move in there. When you talked about in traditional times, we would think about America, the U.S. dollar, their bond market, their equities being a bit of a safe haven. Things are different this time because of certain conditions with trade and American exceptionalism. I mean, for years, we kept looking at the outperformance of America. And are we wondering, is it over?
Exactly. And there's certainly a lot of areas of concern. And I think China outperforming the U.S. 30% in a risk-off environment would be a cause for concern. And that is one of the things that has been talked about in markets is there an end to this American exceptionalism trade? And also that combination of the weaker dollar and rising treasury yields, it's another source of concern of, is the U.S. debt sustainable? What I would say, the first thing is I think it's very dangerous to reposition portfolios aggressively on the assumption of a major economic regime change. change. This certainly seems like things are starting to shift. The U.S. government under this administration clearly wants to reduce dependency on trade. They want to reduce people's dependency on the U.S. military for defense. You're also seeing other sort of shifts in terms of government priorities, which sort of lends itself to this narrative that American exceptionalism may be ending. But we actually prefer to take a more gradual approach and a more data-driven approach. So we actually want to wait until it shows up in the numbers. And for us, that would be things like corporate profit margins and corporate earnings. If there actually is an end to this trade, or if things are starting to deteriorate, you'd see margins coming under pressure and earnings coming down. We're not really seeing that at this point in time. Now, it's still early. Things can change over time. But if we look at things like earnings revisions and earnings growth, the past decade has clearly been one of American dominance. We're not really seeing any other regions stand up and take over that growth in a significant way. Maybe a little bit in Japan. That started to pick up a little bit. But even over the last few weeks, as we've seen some uncertainty trickle through into earnings revisions, the U.S. is holding up pretty well compared to all the other regions globally. So when we sort of step back and just think about what has allowed the U.S. to have this earnings growth and be a superpower over time from an economic perspective, one of it is the rule of law. Now, there's certainly some question marks right now based on what's going on, so we'll see how that settles out. But on a relative basis, the U.S. still has probably one of the best legal systems that supports property rights and businesses. You have a very dynamic economy and labor market, so companies in the U.S. can adjust a lot faster and a lot more easily than European and Japanese competitors. And then at the end of the day, it also sometimes just comes down to who shows up for work. Americans work more per week in hours than pretty much any other developed market economy. And so when you just look at some of those sort of long-term structural drivers, if those were to start to shift, if Americans suddenly said, I'm not working, I can't buy all my stuff anymore, something like that could be a bigger sign that there's a bigger deterioration in economic growth or earnings growth. We're just not seeing it at this point in time. And then the last thing to mention is that U.S. companies are very good optimization machines. They will find ways to preserve profit margins, shifting production around if they need to. You're already seeing that with Apple, for example, talking about moving some of its production over time. There's going to be more and more of that over time. And so our view is, instead of taking a big shift, selling all of your U.S. and going international, we prefer to take a gradual approach and actually look for companies where there's clear signs of margin weakness and deterioration. That's when we would make a bigger adjustment in portfolios as we see those changes flow through. Big
issues to keep an eye on in the here and now, but also in the longer term. What about, we're still in the thick of earnings season. We have a lot of companies report. What's the tone, the mood of it right now?
So I'd say a bit of a good news, bad news scenario, depending on exactly what you're looking at. One of the things that we like to track is the number of companies that are beating both on the top line and the bottom line. It's a little bit of a harder bar to cross. In the last couple of quarters, we've seen that number hover around 30%, so roughly 1 in 3 companies have beat both. This quarter, it's ticked up to 40%, so which is perhaps a little bit surprising given some of the uncertainty and the economic environment. And part of that is just driven by sell-side analysts have been cutting estimates a little bit. It's made it easier for companies to beat. The downside is those beats are coming in at a very, very small margin, a couple of pennies. It's actually one of the smallest margins that we've seen in the last couple of years. And so it's not really a high-quality beat. This isn't broad-based economic growth. This is more almost accounting gimmickry of companies finding ways of accelerating revenues or deferring expenses. That's a bigger part of what's driving earnings this season. The other thing that we're seeing is companies are very hesitant to provide guidance. Only about 15% of companies are giving guidance this quarter so far, compared to normally it's more like 25 to 30. And then as you go through different sectors where there's clear weaknesses in the consumer discretionary side, airlines in particular have called out some uncertainty. You're seeing consumers pull back on big ticket purchases. One area that's positive, though, is on the data center side and the AI trade. We had a good print from Google last week. They maintained their CapEx guidance at about $85 billion. That's a positive. A lot of people have been very concerned about what's happening with data centers after DeepSeek and some of the news from Microsoft pulling back. The Google numbers last week were encouraging. We also had a great print from Digital Realty. They continue to have very strong leasing volumes on the data center side. About 2/3 of their leasing activity is focused on AI. So I'd say that's been a pocket of positive news. Investors have been fairly concerned about the data center trade, and at least the incremental or the initial data points that we've seen from earnings so far would support that still seems to be reasonably intact.